Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. Softcat PLC. I'm looking at these as a potential defensive stock. Softcat provide IT infrastructure services and solutions. Now there's different modules of activities they do. So these are services which all kinds of organizations and companies, they need to outsource this. These are the experts who can come in and set up all this new digital and new IT structure for your business. So their revenue is split between software, hardware, and services, with really software and hardware taking half of it roughly. They split their products into 4 areas, which are hybrid infrastructure. Now, hybrid infrastructure is a current buzzword, and this is where companies have parts of their operations and IT based on cloud networking, and part of it using more traditional methods where your data is stored locally. And this seems to be a growing trend. And so this is a very important part of their business. They then also do full digitalization through their digital workspace products. And so this is where, you might even come in and have special apps set up, and you're linking data from your products to then overall databases. And this is a very important part of making some more technologically interesting companies more competitive. They then are also into cybersecurity, so they can advise big firms on cybersecurity and help build the structure there to protect them. And then also a kind of newer thing is they're into IT intelligence. So there's obviously lots of companies generating lots of data, perhaps using some of these digital workspace and hybrid infrastructure tools. And they're able to help companies analyze this data and turn it to improve their services and help them work more efficiently. So it's interesting that they are quite kind of diverse. Comparing them to Kainos, who I looked at the other week, they have a bit more of a diverse customer base. In fact, half of their customers are small, medium businesses, and that's good. Then about a third is public sector, and then the rest is enterprise, which I think means big corporate organizations. So nice, diverse set of customers. They have about 7% of the UK market share, and in some of their reports, they seem quite confident in increasing this through their growth strategy. Now, they're mostly based in the UK. Their growth, which is quite impressive, has always been organic. And I like companies that have this conservative approach. They are going to move internationally, but they're going to do it slowly and organically from these original locations that have come about from new customers. Their net income history, really nice gradual increase over the last 5 years. And in their first half investor presentation, they showed how this has all been achieved through organic growth, and their customer base gradually improves, and the amount of money they get per customer has improved gradually. So they've got a very good trend in how they're growing their revenues and their net income, and that actually not a single customer accounts for more than 2% of their gross profit. So they're not reliant on any individual clients for their great results. Softcat listed on the London Stock Exchange in November 2015. Now you've seen their really nice steady growth in net income over the last 5 years, and their share price has, of course, unsurprisingly increased as well, particularly in the last 2 years. Main events were they got a new CEO, Graham Watts, and their previous CEO, he didn't leave, he stepped up to become chairman. They then really, as I went through before, Their growth has been mainly organic and more through their focus on customer service, really. They opened 4 international branches in 2019, but this is part of slow organic growth. It's not like they're buying pre-existing setups. It's just where they got new customers and they're slowly getting their foot in abroad. They also opened a new office in Birmingham in 2019. You can see on the map here, they've got a kind of a reasonable spread now throughout the UK. Really, generally, it's an uneventful story without big headlines, and that's a good thing. Then, of course, though, one big headline was the COVID virus, and their share price did go down. You can see here their 5-year trend. It's the approximately flat FTSE, and you can see they dropped and they're back up again. I can go here if I expand this. So you can see that this is at the beginning of the COVID crisis, and they went down with the FTSE, but not by so much as the average stock. They're currently 10% discount to before the COVID crisis. Now, it's only been positive news for this company, and at their interim, they announced that they were going to pay their interim dividends. However, only a couple of days later, they then came out with this RNS where they say that they're going to cancel the interim dividend only a few days after they'd announced it. So this is obviously really bad, but they do say in this update that business is all going along as usual. But still, that's definitely a negative to mention. So my executive summary for Softcat is that they are an excellent play on IT, small and medium businesses and large entity investment trends. They've got a nicely balanced market diversification between small, medium business, corporate and the public sector. And they have an organic growth strategy, which I find very appealing. Their sales strategy has been very well laid out in their last investor update. And they're quite a convincing long-term growth story. They have potential for organic international growth as well. However, they're currently just got their foot in the door. I looked at their financials, and they have shown excellent increases in revenues and net income over time. They've got good assets growth, and they're 50 million in cash. And another great thing about them is they've got 0 debt. Look at this, 0 debt, amazing. So my strategy for this stock is to buy them as a defensive stock based on the sector that they're in and the relatively long-term safety of their revenues. I plan to buy them in the next 6 weeks. I'll be comparing them against some other stocks and then keep an eye on the overall market trends. But these are definitely top of my list really at the moment. I'd plan to hold them, get through this crisis period, and reassess only when their growth trend taps out. An important thing would be keep an eye on their revenue net income growth trend. And risks that I could identify are if there was some serious long-term reduction in revenues from the corona crisis, if their revenue was to drop from their organic strategy, and if the current trend of companies coming online with this cloud and hybrid computing was to end. That is something that would affect Softcat's business model. That was my executive summary. Now to go into some more detail. So what's really impressive about Softcat is this steady increase in income and their steady increase in net income. It really is a very nice trend. They've also kept their cost of sales and administrative costs down a bit. Now, here we can see how there is actually even a slight spread between their income and expenditure. And so this follows a story of their net income increasing quite nicely. At their year half 2020 investor update, there was this nice slide where it shows how their customer base has increased and the amount of money they're getting from each customer is also increasing. And so this explains how through organic growth they've managed to increase this revenue and net income. We see here that they're split between hardware, software and services. And here I've put together how you can And you can see here from this graph that really the hardware and software is where the money's coming in. So really, for what I got from their H1 report was that they've got their client managers based mainly in the UK, and they are just from local businesses managing to pick up more and more contracts. And these main four areas of hybrid infrastructure, digital workspace, cybersecurity, and IT intelligence, these are all products that lots of companies out there need because of the current recent trends in IT and how businesses and corporations increasingly rely on IT. So we can see that they're getting more customers through organic growth, through a good sales process, and they're getting more money from each customer. And this is a trend that's only been accelerating. So based on the detail I saw in their annual report, I'm quite impressed with them. So from everything I've seen, I think that this trend of increased net income should continue. So looking at their assets, you see that actually most of their assets are just current assets. They're kind of a fairly footloose setup, as seems to be the case with a lot of these IT service companies. But there's like a general increase, but really that's just mostly as they do more and more business, they've got a lot more inventories and other trade and receivables and things currently in the books when they do their reporting. They've got around 50 million in cash, which is nice. But what is really nice to see is that they have zero debt. I really like their style of organic growth and not using debt to grow. I looked at their equity, but I do know that the majority of their equity is basically retained earnings. And so that's something that's quite easy for me to understand, and that's good. Retained earnings being just money that they've saved from previous profits. So I wanted to think about valuation, and I put them up against some other IT style companies, and we see that their price to book seems to be the most expensive. Although I did say before they were quite footloose, but still it seems quite expensive here. Their price to earnings is kind of in the middle, I guess. However, often what you find is when you go on price to earnings, some of the cheaper ones, when you investigate, there's something really wrong. And so that's why there's a low price to earnings, because the share price has crashed. Still, it's kind of livable, doesn't seem too excessive. So my current plan is to buy one stock a month. And I've currently really got 4 leading stocks. So Softcat, Cranswick, which I'm going to do a video on soon, and Gamesys are definitely the ones I like the most. And really it's a case of deciding which one of these is my best bet later this month. I think it's best to have a little bit more of a wait and see. It's horrible. It's been horrible seeing Softcat's share price rocket the last few days while I've been studying them. But I need to have a look at Cranswick, and then I'm going to go for the best one. I think that actually Cranswick and Gamesys Group are kind of more defensive than Softcat. I think that the Cranswick, which are a food sector, and Gamesys Group, which is gambling, really are hardcore defensive stocks, and that's why they're at parity. Whereas Softcat it's a partial defensive stock probably, and it's 10% down. I just need to look at the stock market really. I want to give it another week or two, because we've still not made this high again that we made in the end of April. I just want to be patient a few more weeks, and then depending on what the stock markets are doing and how these individual stocks have done, I'm just going to go in for the stock which I think is the best bargain. Just on the subject of the economy overall, I've got here this macro dashboard, and we had some really nasty news in April. So unemployment in the UK is now forecast to be 6.2%, increasing to 7%, and that is pretty high. And then when we go to the US dashboard I have, we see that GDP is set to shrink 5% and then forecast to shrink 12%. Now, really, that is so cataclysmic that really I even want to think about, do I drop down from buying one share a month to one share every 3 months or something, just in case there really is something nasty this around the corner. And unemployment apparently 14.7% according to one source I looked at. When we look here, this is UK GDP growth. You can see a nasty step change there. And, how quickly is it really going to ramp back up? So all the same, I've been very impressed with Softcat. They really are my favourite alongside GameSys at the moment. They're a very good contender. I've just got to make my final decision now the next few weeks, and I'll let you know which I go for.